Good morning, friends. We'll be discussing the mock test paper, Direct Tax Laws, scheduled on 3rd of March 2019. Now, multiple choice questions. Question number 1. Himalaya Limited is engaged basically in eligible business, being an eligible startup. Gross total income is rupees, included profits of rupees 25 lakhs from the business, and the assessing officer has made a disallowance of 3 lakhs under 40A, 1A, and rupees 2 lakhs under section 43B. Now you are required to compute the deduction of the eligible startup under section 80I AC. So 100% of the profits will be eligible for deduction, and here the profits will be rupees 25 lakhs plus rupees 3 lakhs, whatever is the disallowances under 40IA, and rupees say 2 lakhs. So the amount of deduction admissible will be 100% of 30 lakhs. So answer will be 30 lakh rupees. Now question number 2 was relating to set off of losses. As you are already aware that loss from house property can be set off to the extent of rupees 2 lakhs. Here the loss is rupees 2 lakh 80,000, but the same can be set off to the extent of rupees 2 lakhs. So, and short term capital loss cannot be set off from any other head except what? Capital gains. So business loss is there of ready-made garments, which will be set off from business of profits of consumer business, and loss from house property to the extent of rupees 2 lakhs will be set off, and the total income will be rupees 3 lakh 32,000 rupees. So this will be the total income, and answer will be 3 lakh 32,000 rupees. And question number 3 was relating to eligibility of deduction under section 80D. Insurance premium paid is 22,000 rupees for self and spouse. Besides this, expenditure incurred on medical treatment of father who is a senior citizen is 47,000 rupees, and he has not been insured and expenditure has been incurred on his medical treatment 2,400 rupees under CGHS scheme, and he has incurred 3,000 on preventive health checkup for himself and the spouse, and 4,000 by check on preventive health checkup of his father. You are required to compute the eligible deduction. So here 22,000 rupees will be eligible on account of medical insurance, CGHS 2,400 rupees, and as you are already aware that the total amount of deduction which is admissible to such individual will be cannot exceed 25,000 rupees. So 600 will be on account of preventive health checkup. So 25,000 for that individual, and in case of medical treatment of father 47,000 rupees will be the eligibility, and preventive health checkup 3,000 will be eligible, and the total amount of deduction will be 75,000 rupees. So here the answer will be rupees 75,000. Next is Mr. Shiva, aged 58 years, having gross total income of rupees 6 lakhs. You are required to compute the amount of deduction under chapter 6A, that is 80G deduction. 6, that is what national they have contributed towards National Children Fund, and donation is towards public charitable institution 50,000 rupees. So basically 50,000 rupees here, 10% of adjusted GTI will be eligible for deduction, and National Children Fund without limit 100% will be eligible for deduction. Jawaharlal Nehru Memorial Fund without limit 50% will be eligible for deduction. Then donation to approved institution for promotion of family planning 100% will be there, but subject to limit of 10% of adjusted GTI. So these 50,000 and 40,000 will be, first we have to see The adjusted GTI is rupees 60,000. So 40,000 will be selected for family planning and 100% of the same will be eligible for deduction. And remaining 20,000 rupees, 50% will be eligible for deduction. So in case of National Children Fund, the amount of deduction will be 25,000 rupees. In case of Jawaharlal Nehru Memorial Fund, 50%, that is 12,500 rupees. Approved institution for family planning, 100%, but subject to the qualifying limit, 10% of adjusted GTI, these two funds. So that is 60,000 rupees is there, 40 here and 20,000 here. And 10,000 will be the amount of deduction. So total admissible deduction in this case will be 87,500 rupees. Now, Mr. Pulkit is aged 45 years, has paid health insurance premium of 90,000 for 3 years. So now it will be, amendment has been made by the Finance Act 2018 with effect from assessment year 1920, and we have to spread it into the number of the years. So 90,000 divided by 3 comes out to be 30,000 rupees. And however, as you are aware that same cannot exceed what? Since he is 45 years of age, same cannot exceed 25,000 rupees. So the eligible deduction will be rupees 25,000. Then an individual is having a business income of say 1,35,000 rupees and lottery income is 1,20,000 gross. Besides this, fixed deposit interest is there and he is aged 61 years. He is a resident. He is invested 1,50,000 rupees in public provident fund and required to compute what? The amount of total income. So PGBP is there, interest on fixed deposit is there, and as you are already aware, the lottery income is not eligible for deduction under Chapter 6A. So his income which is eligible for deduction under Chapter 6A is 1,65,000 rupees. He has made investment of 1,50,000 in PPF that will be eligible under Chapter 6A TC, and interest on fixed deposits 30,000 rupees, the same will be eligible, but subject to limit of 165. Therefore, 165 will be the maximum amount of deduction that will be admissible, and the total income works out to be 1,25,000 rupees. 1,20,000 rupees, sorry, 1,20,000 rupees your total income. Now, next question was in course of search operations under 132 in the month of May 2019, Mr. Akash makes a declaration under 132.4 on the earning of income not disclosed in respect of previous year 18-19. So it's coming under the specified previous year, that is the year preceding the date of search if the due date of furnishing the return has not expired, and he explains the manner in which the income has been derived and he pays the tax together with interest on such income and declares in the same in the return in the month of July 19. What will be the amount of penalty leviable? Either it will be 30% or it will be 60%. So since he have declared the same and it's of the in the return and paid the tax and interest, then penalty will be 30% of the undisclosed income. So here he will be liable for a penalty of 30% of the undisclosed income. Then question number 8 is relating to real estate investment trust. Rental income has been derived of rupees 2 crores. Rental income will be chargeable to tax in the hands of the unit holders, and short-term capital gains will be taxable in hands of the real estate investment trust. Interest income will be given a pass-through status and will be taxable in hands of the unit holders. So basically, you are required to state which of the following statements is correct. So the statement which is correct is what? REIT will enjoy pass-through status in respect of interest income as well as rental income, interest income as well as what? The rental income. And besides this, the same will be taxable in hands of unit holders. Short-term capital gains will be taxable in hands of real estate investment trust. Then question number 9 was dealing with what? Applicability of ICDS on book profits. So ICDS will not apply while computing what? The book profits for the purpose of MAT, because ICDS is applicable only in relation to computation of the total income as per the regular provisions of the Act. The next question was relating to computation of total income of a trust. So here public charitable trust registered under 12AA derived income of 10 lakh rupees from properties held by trust, 15 lakhs as voluntary contributions. So total income before application is 25 lakhs, out of which 15% will be set apart, and the actual application is rupees 8 lakhs and 4 lakhs. So 12 lakhs will be the application. The remaining amount will be chargeable tax, that works out to be 9 lakh, 9.25 lakh rupees. Then dividend which is received by a real estate investment trust, if it is from a special purpose vehicle being a specified company, the same will be exempt in hands of real estate investment trust. Since if it is a specified company, the condition is that there is 100% holding is of real estate investment trust and the distribution is out of the accumulated profits, and the same is also exempt in hands of unit holders unconditionally. So the answer will be exempt in hands of real estate investment trust only if SPV is a specified domestic company, and exempt unconditionally in the hands of the unit holders. Then 12th question was relating to what? Computation of the tax liability of X Limited. Here the total income is 10 crore 1 lakh rupees. So first of all you will be, and the turnover in financial year 16-17 is 240 crores. So applicable tax rate will be 25%. So as you are aware that we'll be giving a marginal relief here also. First you have to calculate the tax on 10 crore rupees at rate of 25%, which is to be increased by surcharge at rate of 7%. And then since the total income has already crossed 10 crore rupees, so if surcharge rate will be now enhanced, therefore we will be giving what? Marginal relief in such a case, and after the benefit of the marginal relief, your liability will be, after an enhancement of a health and education cess of 4%, your liability works out to be 2,79,000, 2 crore 79 lakh 24,000 rupees. And Delta Limited, as a domestic company, declared 85 lakhs as dividend, and the same is distributed to Mr. Ganesh. He receives 12.75 lakhs, and Rajesh is holding 10% shares and he receives 8.5 lakhs. So as you are aware that dividend in excess of 10 lakh rupees is chargeable to tax in hands of shareholders under section 115 BBDA at rate of 10%. So in this case, first of all, the dividend distribution tax is payable by Delta Limited under section 115O, and whatever amount of dividend in excess of rupees 10 lakhs is received by Mr. Ganesh will be chargeable to tax at rate of 10% under section 115 BBDA. So answer is D. Now, Kamla Charitable Trust, registered under 12AA, having its main object of medical relief, earned dividend income of rupees 3 lakhs. So this dividend will be exempt only when the trust applies the same for charitable purpose. 2 lakhs from units of mutual fund, income from units of mutual fund. The 2 lakhs will also be exempt only when the trust applies for it for the charitable purposes. Agricultural income is exempt from tax in hands of the trust also under section 10(1). So which statement is correct? Answer is D. The trust can claim exemption under section 10(1) in respect of the agricultural income without applying such income for charitable purpose. However, it can claim exemption in respect of income from mutual funds under 1023D and dividend income of rupees 3 lakhs only when the same has been what? Applied for the charitable purpose. Then Mr. Harish has an income of 52 lakhs under the head PGBP, and he has claimed deduction under section 80 IB amounting rupees 20 lakhs. So you are required to calculate his tax liability. So we have to see the application of alternate minimum tax. So we'll be applying 18.5% of the adjusted total income. What is the adjusted total income? That is the total income, and then whatever deductions have been claimed under 80 IB, that will be added 18.5% of the same, and which will be compared with your normal tax liability, and in this case AMT will be levied. Now Lima Limited, a domestic company, purchases own unlisted shares. So there's a provisions relating to buyback of shares. 23 lakhs is the amount which has been paid to the shareholders on buyback, and the amount which has been received on issue of shares is 17 lakhs. So on the 6 lakh rupees, the company will be liable to pay distribution tax at rate of 20%, increased by 12% surcharge, and then HEC at rate of say 4%. So the effective tax liability on buyback is 1,39,776 rupees. Now PQR Limited, the domestic company, has distributed on 15/10/18 a dividend of 230 lakhs on its shareholders and has received a dividend of 60 lakhs from its domestic subsidiary company. So whatever dividend is received by domestic subsidiary company by the holding company, the same will be reduced for calculating the dividend distribution tax liability. And the additional amount of income tax payable will be 20.552941% of the net amount so distributed. So it works out to be 34.944 lakh rupees. Which of the following cannot be corrected? So this amendment has also been made this time while processing the return of income for assessment year 1920. That is additions of income appearing in form number 26AS, which has not been included in computing the total income, the return. Now, A Private Limited, an Indian company, is engaged in the business of generation of power, and then the same has been amalgamated subsequently. So whether the amalgamated company is entitled deduction now under 80IB, so amalgamated company will not be entitled deduction. No, B Private Limited shall not be eligible for deduction in respect of profits and gains, since amalgamation will not be recognized after 1/4/2007. So the answer will be D in this case. Now, in case if a company, private limited company, issues any shares, and if the issue price exceeds the fair market value of the shares, in that particular circumstance, that will be regarded as a income from other sources under section 56(2)(7)(b). So here, the issue price is rupees 40 and the fair market value is 30 per share. So 10 rupees will be chargeable to tax as income from other sources, and 20,000 shares have been issued. So the amount which will be chargeable to tax will be rupees 2 lakhs. A charitable trust is registered under section 1125 lakh rupees has been received, which includes anonymous donations of rupees 5 lakhs. So you are required to compute the tax liability of anonymous donations under section 115 BBC here. So how much anonymous donations will be exempt? 5% of the total donations, or rupees 1 lakh, which is higher, and remaining amount is chargeable to tax. So 3,75,000 rupees will be chargeable to tax at rate of 30%, which will be increased by HEC at rate of say 4%. So this will be the tax liability on the anonymous donations. Then Chand Limited has filed its return of income on 7th of December 2019, declaring a loss of rupees 3,50,000 for assessment year 1920. Later it noticed a claim of expenditure has been omitted in the return filed. Now we can revise the return up to the end of the assessment year. So it's assessment year 1920, so you can revise the same up to 31st of March 20. Belated return can also be revised. Now where the quoting of PAN is mandatory in this case, sale of immovable property of 10 lakhs or more, here it is mandatory. If you deposit cash exceeding rupees 50,000 in post office account, it is mandatory. Similarly, contract for sale and purchase of securities exceeding 1 lakh, it's mandatory. So it will be mandatory in first, second, and fourth case. That is, the answer will be B in this case. And XYZ Limited has filed its return of income for assessment year 18-19 on 1st February 19. Scrutiny notice. The assessing officer is required to serve the scrutiny notice. That is 6 months, within 6 months from the end of the financial year in which the return has been, say, furnished. So it will be return has been furnished in 1st February 19, that is 18-19. So scrutiny notice is to be given up to 30th of September 19. Now, A Private Limited is a closely held company. It's a subsidiary of a foreign company in which it has already issued shares of 5 lakh to its shareholders. During the previous year, it incurred loss of rupees 10 crores, which could not be set off, hence the same was carried forward. Further, there was an unabsorbed loss also, unabsorbed depreciation of 1 crore rupees. Later on, during the previous year 18-19, YINC was amalgamated with ZINC, and here only 50% of the shareholders, that is not less than 50% of the shareholders, must become the shareholders of the amalgamated foreign company. So here Since less than 50% of the shareholders are now the shareholders of the amalgamated foreign company, therefore the unabsorbed loss cannot be carried forward by whom? The Indian companies, as per the provisions of Section 79. However, unabsorbed depreciation can be set off. So losses cannot be set off, but unabsorbed depreciation can be set off as per the provisions of Section 79 of the Income Tax Act. And which of the following returns can be revised under 139.5? 139.1 return can be revised, 139.4 return can be revised, 139.3 return can also be revised. So answer here will be D. Shaleen is a businessman whose total income before allowing deduction under 80GG is 4,60,000 rupees, paid a rent of 12,000 per month. So you can claim a deduction, rent paid minus 10% total income. दूसरा that is 1,44,000 minus 46,000 rupees. Other is 25% of total income or 5,000 per month, whichever say less. So here 60,000 is the least amount. The same will be eligible for deduction. Rajan, a resident Indian, has incurred 15,000 for medical treatment of his dependent brother who is suffering with severe disability, and he has deposited 20,000 in LIC for his maintenance. So the maximum amount of deduction that is admissible under Section 80DD, respective of the expenditure so incurred, is rupees 1,25,000 in case of severe disability. Mr. Karan has filed his return of income for AY 1920, showing total income of rupees 7 lakhs on 1120. Now, what is the late fees which has been payable? So return has been furnished after 31st of December and the total income is rupees 7 lakhs. So therefore the late fees under Section 234F will be rupees 10,000. Now XYZ is a charitable registered trust under 12AA, and during the previous year 17-18 has received a specific corpus donation for construction of building which was claimed as exempt. Now, during previous year 18-19, it desires to claim depreciation on the building. So, in case the building has been claimed as application, then depreciation won't be admissible, since here building has not been claimed, the expenditure which has been incurred on building has not been claimed as application. Therefore, the depreciation can be claimed. The depreciation can be claimed on acquisition of building, as building was not claimed as application under Section 11(1)(a). That is a correct answer. So this was relating to the multiple choice questions. Now we'll be proceeding with the comprehensive questions. Now question number 2 is relating to Jupiter, that is you have to require to compute what? The total income ignoring the MAT provisions. Now Jupiter Construction Company and Indian companies engaged in the business of executing civil constructions awarded by various companies, central government and state government in relation to infrastructure facility. Statement of profit and loss for the year ended 31st March 19 reveals a net profit of rupees 85 lakhs. So net profit was say rupees 85 lakhs. Then what are the items which have been say debited and credited? Interest of rupees 3 lakhs is due to financial institution for the quarter ending 31st 28 in last quarter 18-19 and paid on 20th October 19. So since the same has not been paid on or before the due date of furnishing the return of income, therefore the same will be disallowed as per the provisions of Section 43B. 6 lakh has been paid in India to Mr. Philip, a non-resident, for fees for technical services without deducting tax at source. So in case if any payment is made to NR without deducting tax at source, the same will be what? Disallowed under 40A1. 100% of such expenditure will be disallowed. Damages of 15 lakh paid to Government of West Bengal as per the terms of contract for defects found in construction of flyover. So damages which have been paid, it is in normal course of business, and that will be allowed as reduction because the same is not penal in nature. Depreciation charge 20 lakhs, the same will be added back. Then mark to market losses, the same will be disallowed as per the provisions of the section 40A13 read with 36(1) 18 in this regard. So this will be also disallowed. and profit on of rupees 10 lakhs on sale of land to Neptune Inc. USA, which is a wholly owned subsidiary company. So the same profits will be reduced since it is on sale of land, and it will be taken for computing the capital gains liability. This will be reduced here. Retention money amounting rupees 10 lakhs held by public sector company, which can be released after the expiry of 2 years. Since the same is credited, retention money will be regarded as income as per ICDS 3, and therefore since the same has been credited here, no adjustment will be required in respect of the same. 3 lakh being interest on fixed deposits with bank as margin money for obtaining guarantee. So this is basically here fixed deposit has been made for in course of business. Therefore, the interest income will be chargeable to tax under the head profits and gains of business and profession. Since it is already credited to the profit and loss account, therefore no adjustments will be required in this case. Dividend of rupees 10 lakh received from REIT, component of short-term capital gains. Since capital gains is taxable in hands of REIT, therefore it will be exempt in hands of the unit holder. Since rental income consists since this 10 lakh dividend income consists of capital gains of 6 lakh rupees and rental income of 4 lakhs, so rental income will be chargeable to tax, but the 6 lakh won't be taxable, the same will be reduced. So this was in relation to business, and the depreciation as per income tax is 25 lakh rupees. So 20 lakhs will be added and 25 lakhs will be reduced, or the net impact 5 lakh rupees will be reduced. The land was purchased by which was sold to Neptune Inc. was acquired at cost of rupees 30 lakhs. So we'll be indexing that, and resulting capital gains will be chargeable, since here the subsidiary company is not an Indian company. If a transfer has been made by a holding company to its 100% subsidiary company, and subsidiary company is an Indian company, then the said transaction is not regarded as transfer. Here, since subsidiary company is a foreign company, therefore capital gains taxability will arise. Then further information is about, they have given 20 employees and recruited, and all the employees are participating in recognized provident fund. 15 employees joined on 1st May and other 5 joined on 5th of November. So those employees who are joined on 5th of November, since they are employed for less than 40 days, the same won't be eligible for deduction under section 80 JJAA. And 10 employees who joined on 1st May were offered salary of 24,500 rupees. They will be eligible employees. For additional wages will be eligible for deduction, and other employees who joined on the same day would draw a salary of 32,000. So those 5 employees will also not be eligible. Those only 10 employees are eligible, out of which 1 employee has been paid salary in through bearer check. So that won't also be eligible. For 9 employees, the eligibility will be there. In all, 9 employees will be eligible. And what will be the amount? Additional employee cost 24,500 into 10 into 11 for say 11 months, reduced by 1 employee who has been paid by bearer check. 30% will be the amount of deduction which will be admissible. So you have to write the proper working notes here, and therefore the total income will be this, which will be rounded off. These working notes carry half marks everywhere. That is to be kept in mind. Then question number 3A was computation of the total income of the trust, charitable trust. There's income from property held in the trust, that is 25 lakh rupees. Voluntary contributions with specific direction, the same won't be forming the part of income derived from property held in the trust, since it is exempt under section 11(1)(d). And voluntary contributions without specific direction, that will be say included. Expenditure is donation to other public charitable trust. Now they have is 8,50,000 rupees, and income applied for a charitable purpose during the previous year, that is 15,50,000 rupees. Further information is relating to donation to other public charitable trust, includes cash donations 1,20,000 rupees to PQ charitable trust. So cash donation in excess of rupees 10,000 won't be eligible. Bearer check 10,000 ka hi hai, it's not in excess of 10,000, therefore the same will be eligible. So out of 8,50,000 rupees, 1,20,000 will not be eligible because of the amendment which has been made by the Finance Act 2018. So the application will be rupees 7,30,000 rupees. Similarly, 15,50,000 is the application of income, out of which cash payment is 40,000. It won't be eligible. And the consultancy fees which has been paid to yoga instructor without deducting tax at source. So here, since TDS has not been there, 30% of the consultancy fees, the same will be disallowed. 30% of 2,50,000, the same will not be allowed. So application will be 15,50,000 rupees minus 40,000 rupees minus 75,000 rupees. Hence, this will be the total income. You have to write the working notes properly relating to the amendments which have been made. Then X company is engaged in developing and exporting software, is having two units, namely Unit A and Unit B. Unit A is been set up in SEZ and Unit B does not fall under Section 10AA. And you are required to compute what? The total income, and the company is in third year of operation basically. So now eligibility for SEZ unit, the profits are there. They will be, deduction will be separately computed. 100% of the profits will be eligible for deduction. Now how the profits will be computed, that is net profits. Whatever profits have been derived by the undertaking, the same will be eligible and into the export turnover upon the total turnover. So here देखिए, export sales are 600, out of which say amount which has been brought in convertible foreign exchange is 520 lakhs. So what amount has been brought in convertible foreign exchange within time frame allowed, less freight and insurance which has been incurred beyond customs station, the same won't be forming the part of the export turnover. And it has also been now judicially decided by the Supreme Court in HCL Technologies case, and a circular has been issued in this regard कि whatever is not forming the part of export turnover, the same cannot form the part of total turnover also. So 600 lakhs is the export sales, and the amount which is brought in convertible, say foreign exchange, there is 520, or total export sale is 600 lakhs, and freight expenditure is 100 lakh rupees, the same will be reduced. Domestic sales is 100 lakhs, therefore the total turnover works out to be what? 600 lakhs. Export turnover is 450 lakhs. Then we have to work out what the profits. Now net profit as per profit and loss account is 251 lakhs, and information has been provided that 12 lakhs is disallowed under 43B, the same will be added. But further information has been provided that the profits say includes what? Duty drawback and profit on import entitlement. The same is not forming the part of the profits derived from business undertaking. The same will be reduced for the purpose of eligibility of deduction. So the profits will be what? 232 into export turnover, that is 450 as computed above, upon total turnover, that is 600. So 100% of the profits will be eligible for deduction. Now, when we'll be computing the total income, net profit as per profit and loss account is 251. Disallowance under 43B, the same is added back. Similarly, here other unit is 615, and disallowance under 48.3 is here for the other unit, normal unit, is 60 lakhs. And the profits and gains of business and profession works out to be 938. Eligible deduction is 174. Therefore, total income will be what? 764. Now, question number 4A was case law based question, where Skyline Hospitality LLP had acquired the rights and liabilities from Skylight Hospitality Private Limited SHLP upon conversion under LLP Act 2008. So LLP, that is company, was private limited company, was converted into limited liability partnership, and subsequently a return was furnished and a notice was issued under 148 relating to on information of tax evasion report. Now company is contending that is LLP is contending that since it has been issued to the LLP, the same is not valid and notice has been issued without live nexus and reasons to believe that income has escaped assessment. So the first issue कि भाई the notice has been issued without live nexus and reason to believe. The Delhi High Court contended in this case, that is Skyline Hospitality LLP. The Delhi High Court contended that there was a sufficient evidence with the department relating to the income has escaped assessment, and since tax evasion report has been received from the investigation unit of the department, and the same notice cannot be regarded as invalid in such a case. They have a reason to believe, and it's not merely on reason of suspicion that they have issued kya income escaping assessment notices. And in such a cases, when there's a reason to believe and not merely reason to suspect, court cannot interfere and stop the adjudication process in this regard, since there was a material evidence relating to what income escaping assessment. And the second was what the notice is not protected under section 292B, as issuance of notice was incorrectly in the name of SHPL. The same has been done intentionally. So here, basically the notice, secondly, there is a clear evidence the notice was erroneously addressed as SHPL instead of what? SHLLP. So it was to be addressed to the LLP because company has been now taken over by the LLP. And in the notice, the same must be mentioned that it was for erstwhile company, now LLP. The same was a defect in the notice, but the same was curable defect, and it cannot invalidate the proceedings as per section 292B has been enacted to ensure that technical processes, lapses such as mistake, defect or omission or procedural irregularities does not invalidate the assessment proceedings in case if the assessment proceedings are in substance proper. So here the income escaping assessment notice has been issued with material evidences on record by the department that income has escaped assessment, and there was a technical error that is issued. It has been issued in the name of the company, and LLP knew that the fact. So merely on this technical error, the notice cannot be held to be invalid. So Delhi High Court held that notice issued under 140 on basis of tax evasion report received from investigation unit by the income tax department is valid, since there was a reason to believe that income has escaped assessment, even though the notice was erroneously issued in the name of the erstwhile company, which has now been, say, converted into LLP. The LLP has not been, say, taken on record. The next question was in relation to the dividend income, dividend distribution taxability in case of a company which has been engaged in growing and manufacturing tea. So the Calcutta High Court in this case has earlier contended that since 60% of the income is agricultural income and 40% of the income is the business income, therefore only dividend distribution tax must be paid on 40%. Company was contending that since the entire income is say that doing agricultural operations, therefore the shareholders are receiving that nature of income, and hence no dividend distribution tax liability must be there. However, the Supreme Court decided the issue that here in the hands of the shareholder, the income basically it is not partaking the character of agricultural income. The income in the hands of the shareholder is not partaking the character of what? Agricultural income. 115O basically pertains to additional tax at the stage of distribution of dividend by a company which is covered under entry 82 of list 1. When dividends is declared and distributed and paid to this company's shareholder, it is not impressed with what? The character of the source of income. It is not basically impressed with the character of what? Source of income. This has been already decided by the Supreme Court in Bachayev Gujdar's case. Therefore, its dividend is basically not a revenue which has been derived from land, and it cannot be regarded as agricultural income in hands of the shareholder, as has been judicially decided by the Supreme Court in Bachayev Gujdar's case. Therefore, on this basis, the Supreme Court held that on the entire amount of dividend which is distributed by a company which is engaged in business of growing and manufacturing tea, on the entire amount, dividend distribution tax would be, say, levied. The dividend distribution tax would be subject to the for entire income, and it is not only 40% of the income will be subject to 40% of the dividend so distributed will be subject to dividend distribution tax. Now the next question was relating to a notice to levy penalty under 270A was issued on 11/6/18. The assessee in response thereto filed a written submission requesting to decide the matter. Later on, the office, there was a change in incumbency of the office, and the subsequent the new AO levied the penalty. So without further for providing opportunity of being heard. So until and unless the opportunity is demanded by the assessee, and since he has addressed to the AO to say written whatever you decide you want to do, decide the matter, and new AO has now joined without assessee demanding for the opportunity, no further opportunity is required, as has been judicially decided by the Supreme Court in Pradeep Lambwork's case. The next question is in relation to computation of the total income of the firm. Firm is engaged in the business of production of TV serials and television films, and they say that the net profit as per profit and loss account is rupees 10 lakhs, and one partner has retired whose accounts have been settled during the year under consideration. So taxability will arise as per the provisions of section 45(4). Capital gains taxability arises in hands of the firm when the accounts are settled of the retiring partner, when the distribution such takes place. So here profit and loss account is 10 lakh rupees. Interest has been paid 15 lakh rupees to X and Y on their balances standing to the capital account on 1st April 18 to 31st of March 19, and the deed has been revised for making payment of interest, and the same is at rate of say 15% per annum. So April, May, June the interest will be say disallowed, and then whatever is in excess of 12% the same will also be disallowed. So two disallowances will be there, that is interest of April and May, the same will be disallowed, and whatever excess interest is there from June 2018 to March 2019 in excess of what 12%, that is 3%, the same will be disallowed. So total disallowance amount will be rupees 5 lakhs here. Then whatever remuneration is paid to partners in their representative capacity, the same will be added back and will be allowed only in accordance with the provisions of section 40B on the basis of the book profits. Interest amounting to rupees 2 lakh is paid to Z on loan provided by him in his individual capacity. The Z is a partner in a representative capacity, and since he has provided loan in his individual capacity, the same cannot be taken for disallowance under section 40B, even if it exceeds what 12% per annum. Royalty of 5 lakh is paid to partner who is a professional script writer. So whatever amount is paid to partner, when it is same is paid to partner, the same will be coming under the ambit of remuneration. Once it will be disallowed, and then as per provisions of 40B it will be allowed. Cash payments have been made on 1st February 19 to one person, the same will be disallowed since it exceeds rupees 10,000, and to the other person on 2 different days it do not exceed rupees 10,000, the same will be allowed. And one payment of rupees 5 lakh has been made to NR without deducting tax at source, 100% of such expenditure will be disallowed. Provision for gratuity, to the extent of provisions so made, the same will be disallowed, and whatever gratuity has been paid to the retiring partner, the same will be allowed. So net amount of rupees 1 lakh, 6 lakh minus 1 lakh 50,000, that is 4 lakh 50,000 rupees will be disallowed. Interest of 1 lakh 20,000 has been credited, so that the same will be reduced, and interest on income tax refund since it's income from other sources. So your book profits works out to be 58 lakh 63,000 rupees. On first 3 lakh of book profits, the remuneration will be 2 lakh 70,000, and on balance at rate of 60%. So this is the remuneration, and as per the deed it is 35 lakhs. So lower will be allowed, that is 35 lakhs will be allowed, and the PGBP will be how much? 23 lakh 63,000 rupees. So this will be the amount of PGBP. The next is in relation to what? The capital gains, since partners accounts have been settled, and they have been settled during the financial year, and he has been given a land, and the fair market value on the date of transfer is rupees 16 lakhs, and land has been purchased 2 years back, and his cost of land is 10 lakh rupees, so 6 lakh rupees will be the capital gains which will be chargeable to tax. Interest on income tax refund will be regarded as income from other sources. So here 1,20,000 rupees is the interest on income tax refund, and the total income works out to be this much. So you have to write proper working notes as they have been presented here. Then you have to calculate the income of the investment fund. As you are aware that in case any profits and gains have been derived by the investment fund, the same will be chargeable to tax in hands of investment fund. Other income is been given a pass-through status and will be taxable in the hands of the unit holders and exempt in hands of the investment fund. So investment fund A, business income is nil, so nothing will be taxable. Business income is 4 lakh rupees. The same will be taxable in hands of investment fund. And investment fund C, there's a loss of rupees 4 lakhs. So it will be nil here. In hands of the unit holders, whatever is amount of capital gains and income from other sources is there, the same will be taxable since it is consisting of 40 unit holders. So capital gain will be 32 lakhs divided by 14 hands of each unit holder, and other sources will be 8 lakhs divided by 40. Similarly, it will be 28 and 8, 70,000 and 20,000 respectively. And relating to the income from other sources is 16 lakh. Business loss will be adjusted at fund level, and remaining amount will be chargeable to tax in hands of the unit holders. Then subsequently for the other year information is there. There's a business income of rupees 4 lakhs, capital gains of 18 lakhs, and income from other sources of 16 lakhs. So out of this 12 lakh rupees, the same will be adjusted, capital gains, and 6 lakh rupees will be subsequently distributed to the unit holders in the subsequent year, and other sources will be 16 lakh divided by 40. Then 6B was in relation to search, was conducted on 2/1/19, and cash of rupees 40 lakh was seized, and assessee moved in application 31/1/19 to release the cash with the explanation about the source. So you can make an application in case if any disclosed asset has been seized along with the undisclosed asset. The person can make an application within 30 days from the end of the month in which the asset was seized for release of the asset. And in such a case, the asset will be released within 120 days from the date on which the last authorization of search has been, say, conducted, that is for the conclusion of the search, with the prior approval of principal commissioner or say principal chief commissioner or commissioner or chief commissioner of the income tax. And in this case, thus, the asset must be released within 120 days from the last date of the authorization of the search. And question number 6C was in relation to what a search was conducted. So how many years assessments will be made under section 153A? So actually it is what, 6 years. Whenever the search is conducted, what are the relevant assessment years there? Preceding 6 years assessment can be made under 153A. However, the income further it is found that besides those 6 years, further preceding 4 years income is there, and that is escaped to tax, and that is amounting to rupees 50 lakhs or more. In that case also, those 4 years can also be opened and assessment can be made under 153A. So here they are just asking the normal provisions here. So it is for those 6 years, that is from AY 13-14 to 18-19, 153A notice can be issued and assessment will be made under 153A. Whatever pending assessments are there, assessment or reassessment proceedings on the date of the initiation of search, the pending assessment shall stand abated. So in this particular case, the assessment year 16-17 and assessment year 17-18 and reassessment proceedings of AY 15-16, they were pending, so these will abate. So 16-17, 17-18 and 15-16 will abate. And what will happen in case the post search assessment orders are annulled, then in that particular circumstance, whatever assessment proceedings have been abated, for those years no assessment would have been made, since the assessment made under search, the same have been annulled. Assessment made under 153 have been annulled. Therefore, in that particular circumstance, those assessments will be again, which were pending there, which have been framed under 153A, and the such proceedings have been annulled, then the those assessments so framed under 153A will be set aside, and again the assessment for those years will be made as per the normal provisions of the Act. So therefore, assessments of AY 1617 and 1718 and AY 1516 will be made as per the 143 and 147 as the case may be. Now here, Thai Limited has furnished the return of income for AY 1819 on 6/6/18, and scrutiny notice was issued after 6 months. It was served after the expiry of 6 months from the end of the financial year in which the return was furnished. However, since Thai Limited has responded to the notice and has not, say, claimed during the course of assessment proceedings that the notice is barred by limitation, then the same cannot be claimed subsequently. Therefore, this assessment cannot be subsequently challenged. It is to be challenged during the course of the assessment proceedings as per the provisions of section 292 BB. So therefore, in the instant case, since Thai Limited has raised the objections to proceedings on the ground of non-service of notice, say within time, the validity of the assessment order can be challenged if the same have been, say, raised. And in case they have not raised, then the assessment validity cannot be challenged. Then 147 issues relating to the same. A notice has been issued under 148, and during the course of assessment proceedings under 147 for the same assessment year, if it comes to the knowledge of the AO that other income has escaped assessment, then he is not required to issue any fresh notice. So one question was relating to the same year, and if the income relates to other year, then but naturally he will be required to issue a fresh notice. So if the income which is found during the course of assessment and that has also escaped assessment, which was not there at the time of issuance of notice, but it relates to the same year, and explanation 3 has been provided that same can be assessed and there is no need to issue a fresh notice. It will be treated as if the AO him has a reason to believe in relation to that other income also, even though he has not earlier recorded any reasons for the same. Then for other assessment year, he will be required to issue a fresh notice. Then a cooperative society engaged in the business of received a letter from the assistant director of income tax to furnish details of persons who have made cash deposits during demonetization period. There is no proceeding pending. So here now amendment has been made last time by the Finance Act. If joint director or say deputy director, assistant director, or say principal director, director, or principal commissioner or commissioner, say issues any letter relating to the inquiry, say under 133(6) also, the concerned person has to respond for the same, because these authorities can issue the notice under 133(6) without taking any approval of the higher authorities. So here, since the notice has been issued by whom? Assistant Director of Income Tax, the same cannot be challenged by the cooperative society. And the one question was relating to whether under 133A can, that is, survey can be conducted at charitable institutions premises. So here amendment has been made. Survey can be also carried out at what? Places where charitable institutions are there or charitable activities are carried on. Therefore, the survey which has been conducted by the assistant commissioner, the same cannot be challenged. So you have to properly write your working notes. They are very, very important. And this suggested answers have been provided to you. So kindly go through the same properly. And they are very, very important. And your presentation is good. Same can be further improved. Thank you very much.